Everybody, Memo here with Nexa Mortgage. And in this Wednesday's realtor meeting, I presented on reverse mortgage. And I saw that there were some, we'll make sure you got this in case you weren't there. So, what I want to talk about is what is a reverse mortgage? So, a reverse mortgage converts a percentage of the home's equity into cash or a line of credit and eliminates the need for forward payments. The HECM, HECM, Home Equity Conversion Mortgage, is federally insured by FHA, and that reverse mortgage is a product that is for people age 62 and older. There are other products that go outside of the scope of the FHA. As you guys all know, when dealing with FHA, there's certain guidelines that you have to follow, and specifically, I'm talking about the loan limit. Should really be a value limit, but the loan limit is 1.209750. So if your home appraises for 2 million and you're only going to get your figures, your line of credit, all the equity stuff based off the 1.2. So not really fair. You're not getting the full potential of what your equity is. So for that, there's other products that we can use called Home Safe, and that one has a maximum valuation of 10 million with a maximum disbursement of 4 million. So pretty cool to be able to do some higher stuff if you've got a more expensive property. So ways reverse mortgages can help increase sales. So for one, it can help buyers get into the house they really want. When people get to that place where they're either getting close to retiring or are already retired, their income is diminishing, or their income all of a sudden becomes fixed because there's no more new money coming into the household. And by new money, meaning something that is just recently earned coming in, because even Social Security was already earned. So that's not new money. Any pension savings or draws from 401ks, any of those, that's old money that they are trying to make last. And when a senior that is already retired and just using their old money to live off of tries to buy something, we have to create income from that old money and increase the draws and have the financial guy say, hey, they're going to draw this much now. And that's how they end up qualifying for stuff. So we're just using all of that money that was already saved up. And in a reverse mortgage, there's no payment, so we don't need to do that. And I'll go over some examples with you about that. The other thing we can do is we can free up some cash to improve retirement. So even if they've got a $1,200 mortgage, what would change in their life if they didn't have to pay that $1,200, right? All of a sudden, they can do more with it. When you do get cash out or a line of credit, they can use it for whatever they want. It's theirs to have. Can gift it to the grandkids and watch them blow it. They can use it as early inheritance. They can go on trips. They can do whatever their little heart desires. Okay. So if you're a real estate professional and not focused on a retirement market, you're missing out on assisting the largest demographic of people in our history that will need housing choices for a long time to come. So this person's been 18 years in reverse sales and education. This is her opinion. And it's hard to argue about the largest demographic. Everything in life has grown with the largest demographic. So a very interesting take on that. Now, here are the demographics. So $11 trillion of home equity is held by people 62 and over. $11 trillion. Okay. A quarter of all home buyers are age 60 and above. That's 25% of our market is 60 and above. They should know about this product. Okay. The number of Americans that are ages 65 and older will more than double by 2060. So it's an enormous market that is continuing to grow. Should we probably focus or pay more attention to it at least? I think so. Now, how do we define equity? Well, if you Google what is home equity, this is what it's going to tell you. Home equity is the value of your house minus the amount you owe on your mortgage or home loan, which is true. However, I think the definition should change when we get into our later years, because while we're getting that new money coming in, it's okay to start building equity, just like it's okay to start saving for retirement, and you put in savings account, 401k, pension, those types of things, right? But when we retire, we want to start to use that money. So when we retire, the definition should change. The home equity is the money that's trapped in our mortgage. It's trapped in the house that we can only access with a transaction. We either have to have a HELOC or we got to refinance it and pull money out to use it. Okay? Because everything else we've done up to this point in life, when we get that new money, we go save it so when we retire, we can use it, except for the home, right? The home we just leave alone, where we should, now that retired, be able to use that equity. So, what are the differences? Okay. There's no age restriction on a conventional loan. There is one on a reverse mortgage, right? The conventional loan, you just have to be 18 and over and be able to get into a legal binding contract, whereas the reverse, you got to be 62 or older. Monthly payments are required on a conventional loan. They're not required on a reverse. But if you do want to make monthly payments, you certainly can. Equity increases in a conventional loan because you're making payments. And not only is it appreciating, but you're lowering the balance by making principal payments. Whereas in a reverse, the equity is decreasing because although it's appreciating, we're adding onto the balance that interest payment every month. Okay. In a conventional mortgage, your liquidity decreases because we're using the money, right? When we're in retirement, we're using the money that we already had in our liquidity and putting it into the mortgage. When in reverse, we're actually increasing it because anything else that you get, whether it's interest on your investments or getting that Social Security check that's coming in, those are increasing your liquidity because we don't have that housing payment. In both cases, the borrower owns the home. In both cases, property taxes, insurance, and maintenance has to be taken care of on the home. On a conventional loan, you risk a foreclosure if you don't make the payments. On a reverse mortgage, it's a non-recourse loan, so there's no payment to miss. And if you know what non-recourse means, it means that the bank cannot come after anything but the collateral that was used in the event of a default. Okay, and we're going to go over when those payments are due, when the balance is due. Okay, in both scenarios, we're going to use equity from a departing residence. The contribution there goes into the transaction. Conventionally, you're going to have a loan balance with an interest payment, and with the reverse, you're going to have a loan balance with interest being accrued. Um, on a conventional loan, you might need to use that money to be able to qualify, either in the way of pulling a bunch out as a down payment to pay cash, or in the way of having to change the draw that you already planned on getting because you need to make this payment and you need to qualify. On a reverse, the goal is to preserve the old money and use the equity for the house and only the house. Okay, so uh, next one is the eligibility of the property. It's FHA. Same stuff that we've always dealt with, right? We need to meet the FHA property standards and flood requirements. The houses that are eligible is single family home, 2 to 4 unit property, which is my favorite, by the way. I'll show you in the examples. FHA approved condos, manufactured homes that comply with FHA standards. So that's pretty simple. We already know all those things, right? So here's one of the examples, a strategy for downsizing. This 70-year-old couple in Arizona sell their home for $500,000 and purchase a new home for $350,000. They can pay cash for their new home, but they want to retain as much of the funds from the sale of the departing residents and increase their liquidity. So how do they do that? Right? First guess is just pay cash. So this is what that looks like. Okay, $500,000 home, 40 in selling costs, 460 is their net proceeds. So they take 350 and buy the house. They have 110 left. Super simple transaction, right? Well, if they did a reverse for a purchase with those same figures, instead of having 110,000, they would take $135,000 reverse loan amount. So out of their 460, they'd pay 214 and change, and they'd be able to keep 245,000. So in this particular example, these folks get to keep more money. Okay. Let's look at another scenario. These people are doing the opposite. They want to upsize. Okay. So this 70-year-old couple from Florida sell their home for $500,000, but they want to purchase a $650,000 home. They don't want a monthly mortgage payment. So the very first thing we do is we look at it. They have a 460 net proceeds. They buy the house for 650. They need 100,000 cash to close. So what are we going to do if they don't want a payment? Well, they're going to have to take from their old money, okay, from their retirement funds, and they're going to move it over into the house and trap it in the house. Okay. If they did a reverse for purchase, their 460 net proceeds, they would take a reverse mortgage for 259. So their contribution from their net proceeds would be 390, and they'd have 67,000 left, and they still don't have a payment. So they accomplished their goal both ways. Now here's the one. The multifamily. 62-year-old couple wishes to purchase a new multifamily home without incurring a monthly mortgage payment. Their goal is to collect the rental income for the other units in the home. So what do? They're going to take their $500,000 proceeds, buy a $700,000 duplex, and they need another 200 grand to close. So what do? They take a small mortgage. The payment's $955, and they're collecting $1,500 in rent. So their cash flow in that property $505. So they accomplished their goal. But what could they do on a reverse for purchase? So reverse for purchase, they're going to take that $500,000, and they are going to take a 240 reverse loan amount. So they're only going to use 459 of that 500. They're going to keep 40,000 either in cash or line of credit, and they have a $1,500 cash flow. So in this scenario, they also accomplished their goal. But if I don't have a payment and I'm renting everything, I think that's pretty good cash flow. Okay. So repayment. First of all, a reverse mortgage, you don't have to make payments. And the only time you actually have to pay it back is when both parties die. Okay. When both borrowers, if it's a couple, if they pass. It can be paid through life insurance proceeds if they have a policy. It could be paid by putting it on the market. The heirs can put it on the market and sell it. And the heirs can purchase it themselves if they want. Either they pay the balance off with their own loan, or they can sell the home for 95% of market value, whichever one is lower. So if the folks have been in this loan a long time and they are underwater, the kids can still buy it for 95% of the market value. Okay. Now, there is a financial assessment that is made, and that financial assessment is basically to make sure that they can pay the taxes and insurance on the property. If they can't, if their credit score is too low, or if they have a history of paying late on taxes and insurance, then they'll need what's called a LISA, which is kind of equivalent to an impound account, where they're going to take, say, $80,000 of the equity and set it aside. So LISA is LESA, life expectancy set aside, so that they don't have to worry about that. The bank will just draw from that fund as long as they have the equity to be able to do it. Okay, so who do you know? Any existing clients this could help? Could you have a family or friends that would benefit from not having a mortgage? Could a reverse mortgage conversation help you in your business? Let us know if you want to have more information or you want to do a one-on-one. I'm happy to help. Thanks.